July 23rd, 2024. My first thought, sorry, it's a little laggy. My first thought was that we basically were opening within yesterday's range or within yesterday's trading range towards the end of the day. So I thought that it's a lot better to be cautious early in the day because we're opening within a trading range. So, when you're in this type of range for this long, we've been in a trading range for roughly 30 bars at this point. So the odds are relatively neutral of a breakout in either direction. And in general, there's a 50% chance that the first breakout is going to fail and the market's going to pick the wrong way. No matter how strong a move is on the open, there's a 50% chance it's just a vacuum test of some sort of support or resistance. So you can get a lot of strong moves on the open, but a lot of times they're not going to end up going very far. Bar one, you can see we traded below the trading range and we got a failed breakout below the trading range on bar one. So it's a potential bear trap on bar one and we get a reversal back up, but it's just a doji bar. Bulls, in order to buy this, we're hoping to get a strong bull bar closing near its high. Instead, we got more or less a doji bar. So it's really not worth buying above one. I would rather wait. Bar two is consecutive bull bars. So two is good for the bulls. It increases the odds that we're going to go at least a little bit higher. We're probably going to get above yesterday's high. However, I don't know how far above yesterday's high we're going to get. You can see on the daily chart that this was the prior bar. So we had three strong bear bars, and then we triggered the sell, or I guess the quote unquote buy above July 22nd yesterday on July 23rd. Sorry, we triggered the buy above July 19th on July 22nd. So the odds are there were going to be sellers, a couple of points, or I don't know, on this chart, maybe 25, 50 points above the July 19th high. And we got to close above it yesterday. So I think the odds were against the bulls getting consecutive strong bull closes on the daily chart. And therefore, I thought the odds were increased that there would be sellers above yesterday's high and that today might close below the open. So bar two, a bull bar closing near its high. Can you buy it? Yeah, you can probably buy it and just take a chance that we've seen the low of the day. There is, I don't know, probably a 1 in 3 chance that we've seen the low of the day after bar two, consecutive bull bars. We are always in long. Whenever we're in a trading range for this long, the market is usually pretty close to 50-50, but it's probably not quite totally 50-50 because, whenever you're not sure what the always in direction is, you just look at the last time it was clear. We were pretty clearly always in long in here, and then we've been going sideways for a while. So I think we are still always in long on the close of bar two, and we now have consecutive bull bars, with one being big and closing on its high. We're probably going at least a little bit higher. Bar three, a good looking bull bar closing on its high. So now we have consecutive bull bars 2, 3. We're going to get a second leg sideways up, even if we do pull back. So what do the bulls need to convince bulls that this is a clear bull trend from the open? Well, because by definition, it is a bull trend from the open because we have consecutive bull bars closing near their highs, with at least one being big and closing on its high. And we are always in long. So by definition, this is a bull trend from the open. We're breaking pretty far above this resistance area, the high of yesterday's trading range, and bulls want bar four to look like bar three. If bar four looks like bar three, then we're probably, that the odds are dramatically increased that this is, some sort of bull trend from the open, and the odds of the bear trend day go down a lot. And then you get bar four. Bar four is not a very good bar. If you were buying, you wanted to see very little overlap. You see how 3 doesn't really overlap 2, and you have a little open gap with the 1 high and the 3 low. Shows a lot of urgency. So the bulls wanted to get 4 as another really big bull bar, just like 3 closing on or near its high and closing far above this price. Generally, when you're breaking above a resistance area, you want to get 2 bull closes and consecutive, relatively uniform, by uniform I mean the same size, type of bar in order to convince traders we're going higher. And 4 is not that bar. To me, 4, there's a pullback. So the big tail on bar 4 is a pullback. And it's so much overlap with 3 and overlap with the breakout point that's really not all that good. It's a bull reversal bar, and you don't want to see a reversal bar in this context because, again, this big tail is a pullback. So on some other time frame, this is more of a spike in channel. And, potentially that's the start of the channel. See spike, pullback. It's not really, spike, pullback, channel. It's not really what I was looking for, though. But Anyways, whenever you get a pullback, you can be expecting that that's the start of the channel. So bar 4 to me looks like more of a channel than a bull trend. So I'm not really willing to buy this high. However, we do have 4 straight bull bars so far today. So bulls are looking to buy because we don't have a bear close yet, and we're in a 4-bar micro channel. So even though I'm not willing to buy up here, the odds are we're going to go higher. And what generally happens when traders aren't quite willing to buy up here, but we're clearly always in long 4 straight bull bars, and we're probably going to get a pullback. You would imagine bulls are going to buy on a limit order around a 50% pullback, and that's exactly what they did. So some traders would buy directly below 4. Oops, I duplicated it. Some traders might buy directly below 4, but other traders will just wait until we reach the 50% pullback, which we did on bar 5, and they'll enter there, basically betting against consecutive bear closes against you. So I would assume, I don't take these kind of trades. I just try to take the easiest 1 or 2 stop order trades on the day. But if you were going to do this, I would imagine you would be buying here, probably with a stop, maybe measure move down of this or something. It's probably not a bad option, because the reality is if you put a stop here, the problem is there's probably more buyers below this low than there are sellers. And, just basically if you get consecutive bear closes 5 and 6, you probably just look to get out. But I don't know. It's kind of difficult if it doesn't immediately go your way, but it does immediately go your way in this case. So outside down on bar 4, or sorry, on bar 5, good for the bears. We might go a little bit lower, but I'm not sure how much lower. After 4 straight bull bars, this is pretty damaging for the bears. And we did get consecutive bull closes above this high, even though bar 4 is not ideal. So I'm really not very sure, how credible anything is here for the bears with this outside down bar. It looks just like a 50% pullback and a test of the moving average. Bar 6, you can see it tests back up to around the bar 4 high. You can see it tried to test the bar 4 high and then pulled back a little bit. So, but what do bulls want? Well, they see this as a breakout. So bars 1 through 4 is the breakout for the bulls, and bar 5 is the pullback. So we have a breakout and a pullback, and now a high 1. So bulls want bar 6 to be a breakout pullback buy. It's an IOI pattern, 4, 5, 6. But it's not really that good. There's a big tail on the top, and this does not look like a really strong bull trend. This really isn't a very ideal buy. To me, it looks like we're going to form some sort of channel up and potentially get a reversal back down. Again, when any bull channel is just a bear flag, and any bear channel is just a bull flag. Sometimes, like this, you get a bear channel that's supposed to be a bull flag, like former wedge bull flag, and you get a breakout below it. But that doesn't happen all that often. Usually, you get, you can see here we had a bear channel towards the bottom of the trading range. This was towards the top of the trading range. So a bear channel on the top of the trading range, slightly increased chance of a breakout to the downside. But a bear channel in the bottom of the trading range is very likely going to be a bull flag. So this, to me, looks like it's forming some sort of bear flag. 7, a bull bar, but a big tail on the bottom and a big tail on the top. It's really not worth doing anything here. Yes, it's consecutive bull bars. Yes, we are always in long, and we are probably going higher, but I don't think the math for anything is really all that great. It seems like this is going to end up being a more sideways to up type of move rather than up. And when that happens, sometimes it makes more sense to just sit and wait. 8, more follow through for the bulls. So 3 straight bull bars, but all of them have tails. None of them are that great. I think we're probably going to end up going more sideways to up rather than straight up, like I just said. So yes, there's probably buyers below 8. That's a credible thing to do. But I don't think anyone wants to buy as, directly above 8. It's a second reversal down for the bears, so it'd be a low 1 here and a low 2 short for the bears, but no one wants to sell below a bull bar, which is just generally not a very good idea. Bar 9, you can see there were buyers below 8 during 9, so probably at least one more leg sideways to up from 6, 7, and 8. I would imagine we're going to test the bar 8 close at some point, because it is, it's not great, but it is a theoretical buy the close bar. So the bulls who buy here and they're scaling in lower are probably going to make money, or the bulls who just take the scale and buy, no, we're probably coming back to here. Bar 10, an inside bar, a high 1. It's a third push up though. 1, pullback, 2, pullback, 3. So it's a third leg up. This is probably some sort of trading range. This isn't looking like a bull trend. This looks a lot more like a bull trend. You know what I mean? With how strong this type of stuff was. Look at this. This bar to this bar compared to this bar to this bar. So this to me looks like a leg in a trading range. This looks a lot more like a bull trend. Obviously, the context over here wasn't as awesome because we're in a trading range and you'd be buying high in a trading range. Even this is, I just use this example, still buying high in a trading range, but strong bars. They're getting bigger and more climactic, but 18, 19, 20, three pretty solid looking bars, reasonable by the close bars. And instead you're getting something like this. So this to me, again, does not look like a bull trend. And this looks like buying a high in a trading range, because this is probably going to be a trading range. I do not want to buy a high in a trading range. So instead, a lot of traders are going to end up choosing not to take the buy, which is why you get a failed breakout of the high. You notice the limit order bears who sold here, they scaled in, they made money. They sell here at this high. What do you think is going to happen? They're going to make money. So this breakout is probably not going to be all that successful. 11, a bear bar closing near its low. It looks scary because it's a pretty tight channel up, but it's probably a trading range. And you have to ask yourself, if this is a trading range, which you should assume that it is because of the reasons I just mentioned. If this is a trading range, what are the qualifications for me to want to sell in a trading range? Well, in a trading range, I want to sell a small bar in the upper third of the trading range. And we are in the upper third of the trading range. It is a small bar. So as scary as bar 11 looks, it looks like a 40% trade, but it might be more like a 50% trade. But you have to keep in mind the channel up is relatively tight. So if we do go down, it's probably going to be more of a minor reversal, expecting a few legs sideways to down, potentially to the bottom of the channel, maybe the bar five close. We did get a leg one, leg two. It was a spike in a wedge channel, but it was also a leg one, leg two. Leg one, leg two. I don't know if it's all that important to know that, but it's just something. Drawing measured moves is kind of fun, so I like to do it. I don't think we got any more of those today, though. I don't know. Let's see. Probably not. Yeah, we did. Okay, so this big leg down, and then a pullback, and then a second big leg down. If you really spend time, I used to when I really was maybe a year into trading, I used to try and look for leg one, leg twos on microscopic levels. I would look for them within trading ranges. So I would look for leg one, leg twos of these three bars, and then a pullback, and then the leg two down, and all sorts of. And I'd get even smaller than that and you'd be stunned that if you really, really just sit there for a couple hours and look for leg one, leg twos on charts. I mean, you'd be amazed at how many you can find. It wasn't a very useful, or it wasn't a very good use of my time, but I did do it. So bar 11, bear bar closing somewhat near its low. It's a wedge channel. You can take the short. What's your profit target? Like I said, the bottom of the channel is reasonable. A new low is reasonable. 20 points. I don't know if the Bears were able to make 20 points. Not quite. It was a smaller day. So, compared to what we've been getting, 35 is a bit of a smaller day. But it's usually when the opening range is pretty big. So when the opening range is big, you expect a trading range day. You can see the opening range here was 23 points. And we might get a 50-point day. But in general, it's okay to expect a trading range day. But when the opening range is small, like 10 to 15 points, especially in the market that we're trading, you should be expecting, some sort of clear breakout and the opening range to at least double. So smaller opening ranges usually lead to trends. Bigger opening ranges usually lead to trading ranges. So you can sell below 11, but tight channel up. So we're going to go more sideways first. You get kind of disappointing follow through on 12, but it is still a bear close. And again, you knew if you took the short that we're not going to go straight down. So it's okay to just hold. So doji bar on 12, a bit disappointing. And inside bar 13, another doji bar. So we have consecutive doji bars, 12 and 13, but they both have bear closes. So we have 3 straight bear closes, and it's going to be a bad high 1 buy above bar 13. It might be a high 2, I suppose, but since bar 11 went to a new high, you could argue 13 is a high 1. Regardless of what you want to call it, it's 3 straight bear bars, and there's going to be sellers above 13 if we do go above 13. So not really all that great for the bulls. And so a lot of them end up exiting their longs, and that's what causes 14 to be such a big bar. When you get 14, you're headed towards the middle of the trading range. It's still, again, a trading range, but I think this makes the market most likely always in short. 15 is a bear bar closing on its low, and it's an inside bar after a bear surprise. So it's a low 1 short on 15. You are selling more towards the middle of the range, but it's a very reasonable thing to do if you're going to sell bar 15. But the problem is you're selling more towards the middle. There's probably going to be some profit taking, I thought, at the bar. I took part off here around the bar 5 close because my logic was this was the start of the channel up. So I thought it was okay to take a piece off in this area and see what happens. Bar 16 is a big surprise and a bit of an exhaustion bar in my mind. Al says it's best to be a pessimist when you're trading, and what he means by that is some traders will look at 14 or at 616 and they'll think, oh gosh, it's going to be a big bear trend, and I'm going to sell the close, and I'm probably going to make a lot of money because it's such a huge bear trend. But the reality is, you're just at the bottom of a trading range. So this is an exhaustion bar. So this is not a sell the close bar. This is a profit taking bar. This is an area you should be taking profits. And it's the same thing with up here. It's really easy to look at this, get hypnotized by the 4 strong bull bars, and think, oh, it's going to be a huge bull trend. If it is going to be a huge bull trend, just wait for the breakout. Wait for a strong close above the bar 11 high and some sort of follow through. You can see you never get it. So if you just wait for the follow through, the breakout and the follow through, in trading ranges, you're going to end up saving yourself a lot of money selling at the bottom and buying at the top, because traders shouldn't be selling down here. It's easy to get optimistic and think, oh, maybe it's going to be a big bear trend. Maybe they'll make a bunch of money. But the reality is, you should be expecting a trading range most of the time. So just, this is more of an area to get out of your longs, or sorry, get out of your shorts. And you can see that with the hesitation on bar 17. Bar 17 is more follow through for the bears, but it's not a very good sell to close bar. You've got a big tail on the top and a big tail on the bottom, so it's really not all that ideal. The bears want a collapse below bar 1. If you're still short at this point, yes, we are always in short, but it's the bottom of a trading range. I would get out above any bar, so I would get out above 17, or you could just wait for a bull bar and get out above 18 if you prefer. But you're giving up a lot of profit, and this is kind of the problem with this: is if you see 16 and you get out somewhere in here, you're saving yourself full 5 points instead of getting out above 18. The reality is, most of the time it's going to reverse here. And the times that it doesn't, you're going to miss out on a little bit, but that's okay. You can just sell lower. So 18, I think, is because bears, they see this and they start taking profits, and that causes a bounce. Would I buy above 18? I personally would not. It is a double bottom with 1 neckline 11, but I don't think it's very good to take that buy. There's a big tail, and I would just rather wait. Had 18 closed on its high, maybe you can buy it, betting that this is a bear trap and we're going to get a strong reversal up. But 18 has a tail on it, so I'm not really willing to take that type of buy. 19, follow through for the bears, or sorry, follow through for the bulls. Consecutive bull bars. It does close, I believe, above the moving average. No, it's not. So it closed just below the moving average. So a bit disappointing for the bulls, I think. But and the tail on the top is not all that great, but it is consecutive bull bars. We are probably back to always and long, but I would just personally rather not buy here. You can and just wait. And the thing is, this is pretty strong. You had 7 straight bear closes, so we're probably going to get a second leg sideways to down. Again, occasionally, 30% of the time, it's going to retrace all the way here before you get the second leg sideways to down. But we didn't, because we never got it here. So we're most likely going to get back to this close at some point today, which is another reason why it's not all that great to buy up here. But if you buy, I lost my train of thought, but my point being, if you're buying this close, you have to have a stop that's pretty wide. You have to be willing to sit through a pullback before you get your second leg up. This will happen sometimes, obviously, where you just get the breakout and it goes straight up. But I think the majority of the time, you're going to get a pullback here. So 20, 3 straight bull bars, closing near their highs. You can buy the close at 20. We're probably going at least a little bit higher. If we do pull back, you're expecting to get at least a second leg sideways to up. So it's okay to think that we're going to go. It's okay to be long here. But I don't know, I don't know how much higher I think we're going to go here, because we're really just looking like it's going to be some sort of test of the top of the sell climax and become big up, big down, big confusion. 21, more follow through for the bulls, but this is a climactic bar. It's the biggest bar of the 4-bar spike, and it's really high in the trading range, and it does not close above the bar 11 high. So if I'm gonna buy up here, you need to do either one of two things. You need to either be an algorithm scalping for a couple of points. You can do it as a person, I suppose, but if you're taking this buy, you just have to realize you're probably going to be disappointed. And I would just really rather wait to see if we get a close above the 11 high. So there's nothing really wrong with, because it is a big buy the close bar and you're in a 4-bar spike. I get it. But to me, I see big bars, big risk at the top of the trading range, the same way I see big bars, big risk at the bottom of the trading range. So I'm not really looking to buy up here. I'd rather wait and get a pullback and then see what happens. It's strong enough to make me think we're going to get another leg up, but at 25 ended up being that second leg sideways to up. So 22, more follow through, and you get a tail on the top. So this is the bar that the bulls really needed to be strong in closing on its high, and a breakout above the 11 high. And what did break out above the 11 high and closed above it, but it wasn't all that strong. There's a big tail on the top of the bar. So disappointing, and a lot of traders probably going to end up taking profits here, and that causes bar 23. It's an inside bar 23. Some bears might bet on a bull trap and sell it, but it's really not very good. I think that we're probably going to end up going more sideways rather than up or down here. Disappointing follow through on 24 if you did sell it. It's a high one buy for the bulls on 24, but after how big this spike was, I think we're going to need to go sideways more before we end up going higher. So not worth buying high one above 24. 25 follow through for the bulls, who bought above 24, but 24 is a bad signal bar, so we're probably going to test back down to it. And it is always in long, yes, and it's a bull bar closing near its high, yes, but I still think this is the top of the trading range. The bulls had to get 22 closing on its high and maybe some more follow through of some kind up here to convince me this is a bull trend, and they didn't get it. So I am convinced we're still in a trading range here. And because I think we're in a trading range, I don't want to buy a big bar at the top of the trading range. This is risking too much, and there's no reason to do it, really. I would just rather wait and see the breakout. If 26 is a bull bar closing on its high up here, then maybe you can buy that and say, okay, maybe we're in a big bull trend. But until then, I'm just going to assume it's a trading range, and it's potentially some sort of wedge here. But so not worth buying here. An outside bar, 26, a big tail on the bottom and a big tail on the top. Bears at some sort of double top, maybe 23, and I suppose it traded below 25, so 23, 25, neckline 24. It's not really worth shorting anything in here, though. I'd rather wait. It's a tight trading range, so the problem with selling 27 is you're selling the bottom of a tight trading range after a strong bull spike. However, it is still a trading range, so you could take the short and take a chance that we're going to get a pretty big retracement, maybe halfway between the bar 17 close and the bar 27 close. So in this area, you could take a chance that we're going to get there. It's okay to sell it. It's an IOI, but I don't know. I just didn't want to sell at the bottom of a tight trading range, so I decided to wait. Also, this was, again, it's still a trading range, but especially 20 and 21 were oddly strong. They were stronger than I was expecting. They were stronger than this. You don't get huge bull bars closing near their highs that are basically this perfect. The 21 is climactic, but they were still really big and very strong bars. So I was a little bit more hesitant to sell up here than I might normally have been. You can see even here, these we got a dramatic move down, but big tail. Okay, bear bar closing near its low, but smaller, more of a reversal bar. Then big bar, but big tail. So I was a bit confused by how strong these were, and that coupled with selling towards the bottom of a tight trading range made me not want to sell 27. But I think it's definitely a credible sell. 28, a reversal up. It's a high 2 for the bulls. It's maybe not the worst buy in the world if it triggers, but I would still rather wait for the breakout above. I'm still more convinced we're in a trading range, so I don't really want to take anything until we end up getting a breakout. 29, we don't trade above 28, so bears might have exited above 28, and therefore they sold the close of 28 and did not let it trigger, and that caused the bar on 29. There's a big tail on 29. It's possibly a wedge, 22, 24, 29, but I'm not really willing to bet on anything until I get a couple of bull bars closing near their highs. If the bull is at this point, this is, to me, it's looking like it's turning into a bull flag. And if it can turn into a bull flag and then we get a couple of bull bars closing near their highs, I'm willing to buy again. But until we get that, I'm thinking this is a trading range. 30, an inside bar, but a big doji bar. It's not really worth doing anything. I think I would just rather wait at this point. Again, what do I need out of the bears? The bears, I need some sort of breakout below the wedge bull flag, and they are looking to get back down to probably the bar 17 close. It looks far, and it is far, but I think that's the target for the bears. Or maybe at least the midpoint between the 17 close and some sort of bear bar closing near its low, maybe 27. The bulls want some sort of wedge bull flag and the consecutive bull bars closing near their highs to convince traders that we are going to go higher. 31, you can see we traded below 30. There's a big tail on the top and bottom of 30 and 31. So 31, yes, it's a wedge, but it's really not worth buying. I would rather wait. It's a bear bar. And you can see there are sellers above. And we get an outside bar on 32. At this point, I'm not doing anything. Again, I need consecutive bull bars. My opinion is still the same. I need consecutive bull bars or some sort of clear bear breakout below. And then 33, a bull bar closing somewhat near its high, but not quite on its high. It's an IOI pattern, so it's a breakout mode pattern. So it's theoretically a buy above and a sell below, but I'm not selling below 33. It's too good of a bull bar. You could sell betting that we get a breakout below the wedge, but I think that's a pretty difficult trade to take. And then 34, disappointment. Initially, buyers below 33. Probably, the traders buying below 33. They bought and they scalped out around the midpoint of 33. pretty common thing to do. And that's what part of what's causing this. I think, the bulls, this is the bulls giving up, right? So it's partially bulls giving up and obviously partially bears selling. And the reason is bulls wanted a wedge bull flag and no one was all that sure as to what was going to happen. And the moment that the bulls started to give up on the wedge bull flag, the bears look and they see, well, we have magnets below and the bulls are giving up. This is a trading range. So they'll start selling aggressively at the market. And that's what causes such a big, a big bear bar closing near its low on 35 is because traders are exiting because now they know that we're probably going quite a bit lower. And the algorithms who are really fast, they notice that we're starting to give up on the wedge bull flag and break below the wedge, 24, 29, 32, and we're breaking out below it. And they think we're going here. So they sell at the market. And that's what causes the bar to get so big so fast is no one's willing to wait for the bar to close because everyone wants to get in. And then when you're down here, you have to be thinking, it's easy to look at it and think, oh my gosh, we're going to go so much lower. But probably not. It's huge risk and you're at the bottom of the trading range. And if this is the target, if you're selling below it, the reason why we don't go straight down to it is because if you're selling below it, you're trying to make 3 points and you're risking like 15. So the equation is better up here to sell because you have good risk reward and reasonably high probability. But now you have just really high probability and your risk reward is terrible. So it's not really worth taking any sort of short down here. I would rather wait. A reversal attempt up on 36. Bears, they see it as a break. They want this to be a big breakout, but they didn't really break out of the necessary things to break out of to convince me it's a bear trend. But they want to see this as a breakout and 36 as a pullback, and then we're going to get maybe a channel down. We did get the channel down, but it's obviously not the channel that the bears wanted. Bulls want 36 to be a bear trap and get a strong reversal up, but 36 is unable to close on its high. So a lot less traders are going to be willing to buy above 36, betting on the bear trap. We are getting higher highs and higher lows, but that might change pretty soon. Again, even if you're considering this is a broad bull channel, which it is a broad bull channel at this point, but it's really just a trading range. It's so broad that it's really not worth considering it a bull channel. It's more just a trading range. Trade it the same way as a trading range. An inside bar on 37. So it's a low one short for the bears. Bulls are hoping bears are going to see the reversal up 36 and use 37 to buy back their shorts. Really, 36 was better for the bulls than the bears. Bears wanted consecutive bear bars. To me, I see 36, I think trading range. So even when you get 37, I think the bulls are willing to buy below and be scaling in lower, thinking that we're in a trading range. And we might have to get back to the midpoint of the trading range, which would be this area. So even they're probably buying down here, betting we're going to get back to the midpoint. As you can see, we did get back to the middle of the trading range, and that's where the market stalled on this rally. 38 buyers below. We traded back up to the bar 36 close and sold off. Bears, it's a low one entry bar, but it's really not very good. There's a huge tail on the top and a tail on the bottom. This to me looks a lot more like a trading range than anything else. 39, an inside bar. It's an IOI pattern again, but no one wants to buy above 39. I still think that 38, 35 was big enough that we're going to get 2 or 3 legs sideways to down. But I'm more looking to buy a reversal up from a failed breakout below the low of the day. So I'm not really looking to sell in here. I'm more looking to buy a reversal up from somewhere in here. 40, a big tail on the top. So tail 39, tail 40, because no one wants to buy above the IOI 39. So disappointment 40. Bears, they want some sort of low too short, but it's a bull bar. There's probably buyers not too far below. And you can see there was buyers below on 40. So bad low too short, buyers below, reversal up 40. Do you buy above 40? I'd probably still wait. It's a doji bar. You can see it never triggered, but it's a doji bar. So I would probably still rather wait unless you're buying with a wide stop. That's not a bad place to establish a long if you're willing to scale in and be flexible with the trade. But if you just, you can't buy above 40 and put a stop, or sorry, that's 41. You can't buy above 41 and put a stop below 41. I don't think that makes too much sense. 42 trades below 41. There's probably buyers below here. They're buying more below here and buying below the day's low as well. Al said something. I was watching one of his old videos yesterday, and he said that in trading ranges, the market will often, if you have support, the market will often go below the second lowest support level, but not the lowest support level. And that happened here on 42. It went below the second lowest support level, which was the higher low of bar 17, and not below the lowest, which would be the bar 1 low. Now, obviously, it's not always the case, but in this scenario, that is what ended up happening. 43, you can see we traded above 42. Well, had we gotten an inside bar, it would have been an IOI pattern and a potential breakout mode buy. but it's hard to want to buy if it closed on, even if it didn't have the tail and it just closed on its high. It's hard to want to buy 43 because you're buying high in this range. You don't want to buy up in this area. You want to buy reversals up from down here. So had 46 been an inside bar closing on its high, I thought that was going to be a really good buy, but instead we got big tail on both sides. Disappointment. 44, bear bar closing near its low. It's a third push down, so it's a spike, and then 1, 2, 3, third leg down. It's not really worth a short. I think if you do take it, what you have to think about what you're actually doing. If you're selling below 44, you're hoping that we're going to get a breakout below the low of the day and some sort of measured move down. So if you're taking the short, you want to see 45 close below the day's low. And if it doesn't, you should just get out. And you get a doji bar on 45, but that's not enough follow through. So for me, I see if you sell 44 and you get this as your follow through, you should be using 46 to buy back your short at break even. That's exactly what happened. And that's why 46 ended up rallying in the beginning, because these bears are disappointed in this. You can't, if you're taking this trade, you have to be extremely pessimistic and extremely picky. You need 45 to be a really good looking bear bar. And if it's not, you need to just be done with the trade. There's no room for hope if you're taking this kind of trade. 46, a reversal up, but a tail on the top. It's possibly, some sort of truncated wedge, 36, 42, 45. And if 46 had closed on its high, it would have been an incredible buy. But instead, it's not closing very strong, so it's not really worth it. 47, a big tail on the top, so really not what I wanted to see if I was looking to buy. But we are still probably always in long. 48, or sorry, we're probably contextually always in long. The bars are always in short, but I think the context is always in long at the bottom of a trading range in a weak bear channel. 48, a doji bar. It's a reversal down from the moving average, but it's really not very good. Again, any sort of reversal down from here, I think, is just going to be bought, and traders are going to be looking to get a bounce. 49, a big bear bar. It's follow through for the bear, or it's follow through for any bear who sold below 48, but there's probably buyers more below 48. And it wasn't an unreasonable thing to do to buy below 48. So the traders who buy below there are probably going to be let out around break even. So we'll probably get back to the bar 48 low, and 49 is not able to close on or near its low. So it's really not all that good. An inside bar on 50. What do bulls want? Well, they want to get something closing on its high. That's, that was the frustrating thing about this wedge channel, is that you didn't really get a bull bar closing near its high until 53, and it's still by the close, and it's reasonable to buy 53. But it would have been better to get a bull bar for reversing up from here. Had we gotten it, we might have gone further. So inside bar 50, but not able to close on or near high. Bulls, again, looking for a reversal up, but they need to get something closing stronger. 51. Another inside bar, so it's an II pattern, but again, it's a doji bar. It wasn't able to close on its high. So bulls, at a certain point, sometimes they just say, whatever, screw it, and they buy anyways. And that seems to be what happened today, betting against a downside breakout. But it's probably better to just wait and see if you get something good. You can take 51, I think, but it's just not all that ideal. I'd rather wait for a bull bar closing near its high. 52, a good looking bull bar. But why is there a tail, and why doesn't it close above the moving average? So as good as 52 looks for the bulls, it seems like bears are giving up. I would still rather wait for one more bar. And they do get the one more bar on 53, a bull bar closing near its high. I think it's a credible buy above 53. You're probably looking to get back to the breakout point of this bar, the breakout below the wedge bull flag. So maybe the 34 low, this kind of area, or maybe the top of the sell climax high with 35 would make sense. But first, we need to break out above the high of this channel. So the bear channel to the 36 high is right here, and we need a strong close above it. 54, it's more follow through for the bulls. We have 5 straight bull bars at this point. It does close above the high, but not very strong. 56, more follow through again for the bulls, but there's a big tail on the top. If looking more like a channel, this seems like the spike. 52, 53, and then the disappointment bar, 54. It's not that disappointing, but it's more sideways. So this seems like it might be a spike and then a channel, 54, 55, 56. So if we look on a lower time frame, I'm sure it'll show it more clearly. Let's look at a 2-minute chart. Well, spike, pullback, channel. 2-minute chart will probably be better. 1-minute charts are always, spike and then channel. So point being, when you get the disappointment bar, or it stops, being extremely strong, you should start to think of the market more as in a channel phase and expect channel behavior like this rather than spike behavior like this. 50 to the 55, still by the close. More follow through 56. Again, we're probably going a little bit higher. This should get a second leg sideways to up. Bulls are hoping we just get, bears just totally give up and we get basically a vacuum test of this low. But you can see we never got it. 57. The bulls, I think this is a problem for the bulls because they wanted a vacuum test. So if it's so bullish and we're going here, then why isn't it acting so bullish? But still expecting a second leg sideways to up from this. So buyers below 56. You can see on 58, we traded back to the bar 56 close. If you held long, you were hoping that the bulls were going to buy more up here and we were going to get a breakout to the upside. Instead, you got a bear doji bar, which is not what you wanted to see. If you continued to hold long, you got another inside bar on 59. You can see it also tested back to the bar 58 close, and traders again just sold out of their longs. If you had set a limit order on 50 at the close of 57 to get out of here, you'd be filled on 58. If you waited, you would have had to get out with a 1 tick or 2 tick loss on 59 if you were quick. A lot of traders, they see the II. They're hoping that the breakout below fails, but it's probably turning into hoping rather than anything probable. So we traded below on 60, and a lot of traders, this is bulls giving up, I think. So a lot of bulls will exit. We still should get a second leg sideways to up from this, which is what I think this was. 61, an inside bar, some sort of high one for the bulls, but not very good. I think 62 is the second leg sideways to up. At this point in the day, I would just be done, to be honest. I'm going to talk through the rest of the bars, but once we start to go sideways, 62, 63, 64, and there's not a lot of potential. I thought there was potential for a bounce here, but then you get this, and no, I don't want to trade anymore, I think, at this point, because you have big up, big down, and there's not enough time for the confusion to really figure itself out. So yeah, we do get a breakout late in the day. If you made money on it, good for you. But I think for me, when I start to see this, I'm gonna be done. 63, a bear bar closing near its low. It's a double top, maybe lower high double top, 59, 63, neckline 60, but not all that great. Just looks like a trading range to me. This is big up, 61, 62, so it's not worth it to sell below 63. Disappointing follow through 64, not surprising. So just get out. That's probably what's causing 65. 66, again, to me at this point, this has formed a trading range here. 60 was the start of the trading range, and we have now found the high and the low of the trading range. It seems like this is the high and this is the low. So it's tight trading range behavior. It's not worth doing anything until we get a breakout above or below the trading range. So you're not selling 65. This is just tight trading range. It's all tight trading range. The only things that, algorithms are scalping on limit orders in here, but it's not worth your time as an individual trader to do that. And then a breakout attempt on 71, but it doesn't actually break out of the high. It breaks out of this, from 64 to 69. But this is really the high of the trading range, and it's really just a vacuum test of the bar 62 close. So there are algorithms that see 2 consecutive bull bars. They might just buy the close and scale in. And so 71 is testing that 62 close. So you need one more bar here. And generally in the stock market, when you need one more bar and you're in a tight trading range, you're not going to get it. There's probably some logic to selling below 72, betting on a failed bull breakout. So 50% chance the first breakout attempt fails. But I would personally just rather wait for the follow through. That might be a more advanced trade. 73, and it doesn't close on its low, and it's right near the moving average if you're selling. So, and in the middle of a tight trading range. So a lot of problems with that, but it's small risk, so it might be okay. 73, follow through, testing the most recent buy climax low, the 71 low. 74, bear bar closing near its low. We're back to sell the close, and we broke out below the trading range, and then we get basically a dump on 75. Traders probably making 10 points in that exiting. Another day where we break out above the 18 bar range and then back below. Pretty unusual. It has been happening a lot lately. It's pretty interesting. The market does evolve with patterns, but I have found that to be a very useful pattern in my couple years of trading. I guess 5 at this point, but I have found that to be useful. And then reversal up 75, but you're buying too high. Again, if you think about it, the low of this is where the trading range started, and the high of 72 is the top of this trading range. If this is a trading range, so you're buying, the middle of it, and then basically sideways. For stop orders, you could have bought above 2 or 3, but you have to understand the risk. 80% chance of a minor reversal lasting at least 5 bars in the open, so it's not as good as it could be. The next one, selling below 11 is good. 15 is good. You can maybe buy the close of 19, but I would not. 20, sure, but just not my personal type of trade. 27 is probably kind of okay. It's probably one of the better trades, but I don't know. It's just not for me. Maybe 51, 52, 53, sure. And then I would be done on the day. Maybe 74 if you're still trading. And, if I'm having a good day and it's just starting to do this, I'm never taking these trades towards the end of the day. And if I'm having a bad day and it's starting to do this, those are the only times I start getting risky. And that's a really terrible habit. So I've started to try to make a habit to just walk away if it's starting to do this towards the end of the day, regardless of my PL, because making decisions based on your financial position on the day, it doesn't matter because the stock market doesn't care about your financial position. So you should trade accordingly to the stock market, nothing else. A low one short here, probably not worth doing anything. Again, there were sellers above here, so scaling in. We might have to get back to here, but the bulls are probably going to form some sort of double bottom, I would assume. We'll probably get back to this high. This is a reasonably strong bull bar, so we'll probably get back to the 722 high. Probably buyers not too far below here. Again, I think we're starting to form the trading range. So this is a couple legs. We might get a couple legs sideways to down into this area, this tight trading range, and then a couple legs up. So I think the trading range is probably going to be from like 57 to 55. So we're probably going to be in this area, give or take. The weekly chart is an inside bar so far. Maybe an IOI pattern forming, but it's not worth looking at yet because it's so early in the week. The monthly chart, though, I would pay a lot of attention to the open of the month. If the bears can get a bear bar closing near its low here, that would be really, really important for them. I don't know if it's going to happen. They have 60 points to cover, but they can do that in a day pretty easily. So a bear bar on the monthly chart is still very much in play, and that would be pretty important for the bears because it would be a second reversal down. All right.